Banks are in crisis. Should you be worried? Are you worried? If you are, in this episode of Friends Talk Financial Planning, we're going to be talking about what we're telling clients. A, should you be worried? And if you should be worried, what potential strategies there are for you to take to alleviate your worries. Hi, I'm Bridget Sullivan Mermel, and I own a fee-only financial planning practice in Chicago, Illinois.
And I'm John Shear. I have a fee-only financial planning practice in Middleton, Wisconsin. And before we start talking about how to make your money safe at the bank, I want to remind people to hit that subscribe button. That helps other people find this useful information on YouTube. And so hit subscribe, and then let's get into it, Bridget. You know, a lot of talk in the news with the failure of two major banks, right? And it makes people a little bit nervous, and in some cases, rightfully so, but in some cases, maybe we don't need to be quite so worried, right?
Absolutely. I mean, people want their money to be safe. I think that's the key element. And so we want to talk about how to make sure your money is safe, right? And so what are you telling your clients, John?
Yeah, and I love that hey, we want our money to be safe, and maybe just a brief background on like what's the problem is that what the concern, if you're not in tune with it, is, hey, I put money in the bank, right? I got savings, I got checking, I got CDs. I expect that when I go to take my money out, I can get it. And the concern is, what if I can't get that out? What if they don't literally have the money to give me, right? That's the problem we're talking about here. It reminds me back, what's the movie? It's a Wonderful Life, right? Like a little run on the bank. Of course, people aren't walking into their bank looking for cash dollars, but it's that same type of thing here in 2023, life. So that's why folks are worried if you're not in tune with it or what's going on with it. And so the question then, hey, here's a couple of banks that have had a hard time and failed. Is my bank safe? That's what I'm hearing from folks. Is my money yet, pick the local credit union, pick the big national bank. Is it safe, or do I need to be worried about that? And one of the things that I tell people is that everybody's heard of FDIC insurance, right? You see the little sticker when you go into the bank or these other things, FDIC insured. One of the things that people don't have to worry about is that if you have less than $250,000 in the bank, and when I say in the bank, checking, money market, CDs, all those things put together, up to $250,000 is protected at your bank, right? So, for a lot of people, you go, listen, when there's reasons why people have more than that for various things, but if you don't have that much, your money is protected by the federal government, by that insurance at the bank.
Okay, that's such a great point, that how the FDIC insurance works. But I want to drill down a little bit and get a little bit more specific about the $250,000 minimum or maximum. So if you've got 5 accounts at your bank, I've got my savings account, my emergency fund, my saving for my trip to Tahiti account. I've got my saving for my new electric car account.
A regular checking account to pay bills with.
Exactly. How does the 250 work? Does each account get up to 250?
Super question.
Oh, and then I've also got a joint account with my husband and individual accounts just with my name on them.
Yeah, right. Like all these things, and you go, okay, well, it's 250. That's simple. Well, no, it's not quite that simple, right? Mm-hmm. And so here's sort of how that thing works in the big picture. And
it is simple for the vast majority of people that don't have $250,000 in the bank. One of the things in researching this that I've seen is that the average bank balance is $5,000. So most people do not need to worry.
Right. And so that the situation you described, let's dig into that a little bit. But I've got, all these different accounts. If they all add up to less than 250, who cares? Right. There's nothing to worry about. Right. So for many, many people, you go, listen, this is just not an issue. Hey, I can forget about this and move on. But there are some folks, right? We've got a client right now inherited money, and they've end up with more than 250 in the bank. Or for some businesses, we'll talk about businesses where they have to spend money, right? Or there are places where it comes in where you go, hey, I got more than this. That's the place you need to be concerned about. And what's, specifically, how does it work? So the rule says that it's protected for $250,000 per person per institution, right? And so note that it doesn't say in there any place per account, right? It's per person per institution. So just let's say that I have $1 million in the bank in some place, right? If we have that, so I have at this bank, I can protect 250,000. Doesn't matter if it's in one account or in 10 different accounts, right? It's that bank. So then to have more protection, I need to have it at a different bank, right? You have to, so if I have 250 here and 250 here, both of those are protected at different banks. If they're all 250 in two different accounts at the same bank, you're capped at that 250 limit.
Okay, so what about joint accounts? So if I've got, let's say my husband and I bank at the same account. Is it 250 for him, 250 for me, and 250 for a joint account?
Yeah, well, it's so on a joint account, then it's per person, right? So you and your husband each have, so you have a $500,000 joint account, then you're covered there.
Okay, so it is 500 for my husband and I at one bank.
Right. A lot of clients will have a living trust account that for estate planning purposes, if you have a living trust, sort of interesting. So it's per person. And if you have a joint account, then it counts as two, right? Right. You get to double that limit. But interesting, just a caveat for people to be aware of. If you have a living trust, really common, your bank statement has, the living trust name on it. It's not the depositor, it's the beneficiary of that account that counts. So what does that mean? All right, you and your husband have a joint account, right? Joint account, 500,000 of coverage. My wife and I have a living trust account, and then it takes a look and says, who's the beneficiaries of that living trust account? And we happen to have two children, so it would be the two kids, we get 250. For each of the two kids, so it's a $500,000 limit. If my wife and I have one child, and that child's the beneficiary, when we're gone, the money goes to them. That one child, that's only protected for 250,000, even though the two of us open it up. Goes the other direction, right? If we had four children and we put, the two of us with our living trust money, put that in there, we've got 250 per each of the four kids that are beneficiaries. We might have $1 million of coverage with our one living trust account at that one bank, right? So that's when you have a living trust, that's just sort of a sideline, a little bit of a different look at things, is that it's the beneficiaries. And, you don't think about these things, right, Bridget? You kind of go like, well, I get and you got to be careful. You go, hey, I know this rule. It's 250. Listen, my wife and I have 250 each. We got 500,000 of coverage. You go, wait a minute. If you only have one kid and it's in your living trust, you don't have $500,000 of coverage, or at least potentially. And there's a neat calculator on the FDIC website, and we can put a link in the show notes, but you can put in who owns this account and how much is it, and which bank, and it'll tell you what's protected and what's not. Great. So there's a really handy way where you can go in there and go, okay, exactly this question. Well, geez, I own this one, we own that one, our living trust owns that one. Who are the beneficiaries? It takes about 5 minutes to plug the numbers in, and you go, oh, here's the thing. And again, I'll just want to circle back and say that if you have less than 250 in the bank total, this conversation doesn't apply to you, right? Don't worry about it. You have to think about that stuff, right, even despite what's on the news, right?
Right, absolutely. So what about businesses?
I was just going to say, here's the right.
Is that like, so I own a business.
Yeah. So if it's
how does that calculate into this?
Yeah, so there's a couple things when it comes to businesses, right? So there's one if it's an incorporated business or it's a legal entity, and there's another if I'm a sole proprietor and I just happen to run a business, and in tax terms, that sole proprietor shows up on your personal tax return, like the business is one of those folders in there, one of those schedules in there. So if I'm an individual and I fix lawnmowers on the side, I've got a business, I'm making some money on that, it shows up on my tax return, my personal tax return, that is subject to that 250. It's subject to my personal deposits, right? So I've got money in the bank for myself, and I've got a separate account for, a handyman fix-it job. Those two things are added together. You don't get double coverage for that, right? So that's just 250. For an incorporated business, a legal entity with things, then that legal entity, Sullivan Vermel Inc. or Trinity Financial Planning LLC opens up an account at the bank. That entity has $250,000 of coverage, right? So if you and I are partners in a business, we don't get double the coverage. Our business gets $250,000 of coverage, right? And when you think about this, you think, and again, these are big numbers we're talking about, right? But if we're running a business and we've got 50 employees, I mean, golly, that might be a payroll run for us. That might be a month worth of thing. Like, as you think about, I don't know if we'll have time to talk about what happened in the banking crisis, but you go, why would you keep that much money at one bank? Well, if I'm a business, I get 250 of protection, and I've got, I might need $2 million in the bank to cover all my payroll and all the things that I rent and all those things that go on. It's just a different scale than, hey, me personally having more than 250,000 in the bank. Then, okay, let's split up between banks or do something different, like maybe buying a treasury bill or those sort of things.
Right. So speaking of treasury bills, let's transition into, okay, let's assume that you are concerned about this, or you really don't want to be checking your bank balances to see, okay, how much I have in there all the time, to make sure that I'm worried about the FDIC limits, because a lot of people have better things to do, quite frankly. So you want to set it up so that you're under the limit. And so let's talk about other ways to make sure that you have government insurance so that you know that your money is safe.
Yeah, you bet. I mean, one of the things I mentioned, treasury bills, and it's different than what we often talk about. We've talked about in the past. It's not setting up a cash flow bond ladder sort of thing, but this is just a deposit account. And treasury bills are literally backed by the treasury, right? The US government is who does the FDIC insurance, federal deposit insurance. This is the same funding company as when you buy a treasury bill. It's backed by the promise that the government's going to pay you that money back. So, and there is a limit on treasury bills. You can buy only up to $10 million. So if you have more than that, you got to be careful, right? But these conversations go away of, listen, I inherited money and I've got, money in different banks and I've got to keep track of this, or I run a business. I've got things. You could put $1 million into one treasury bill that lasts just 30 days. Recently, rates for those are up to 4% or better on an annualized basis. Hey, I can get a good return on a 1 month's treasury bill and have it be fully protected, separate from anything I've got in the bank. So that's one thing that I know we've been looking at for folks.
Well, and you might know I'm not going to need this money for X amount of time. So, or I don't even want to think about this money for 3 months, 6 months,
Right.
a year. I'm just not.
I've got a CD, right? I have a big chunk of money.
But it's going to be a while.
Yeah, I got a big chunk of money that I would put in a CD, but golly, having that for my next house purchase is going to put me over the FDIC limit. Hey, a treasury bill could be a reasonable solution for that.
And you can hold treasury bills at Treasury Direct if you want to go directly to the source, or you can hold them in custodian accounts like Schwab. So it can be part of Schwab that is directly insured by the government. Also, to bring this up, another wrinkle is if you bought CDs at Schwab, that CD would be part of the 250 limit at whatever bank it's at.
Right. Right. So you can do it, at one place, like through a Schwab, and buy different CDs that are actually held at different banks and increase that FDIC protection. Right.
Right. Absolutely. Okay, great. So I think this gives our viewers a lot to chew on with how to get feeling safe, being able to understand what the limits are, and give them some resources too for, okay, if you're concerned about this, here's a website to check it out. With that, I'm Bridget Sullivan Mermel, and I've got a Fielny financial planning practice in Chicago, Illinois.
And I'm John Shear. I run a Fielny financial planning practice in Middleton, Wisconsin. Both Bridget and I are members of the Alliance of Comprehensive Planners. So if you like what you hear on our show, you can check out acplanners.org to find an advisor in your area. And don't forget to hit that subscribe button.